Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Get started. Don't try and hit it for the fence, ones and twos rather than hitting sixes, and just start. As Peter Lynch would say, a really famous investor, it's time in market, not timing the market, which is key. And I think that's really, really important.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How does a nearly 140-year-old firm remain nimble in today's financial world? What's the secret to balancing profit with purpose for retail investors? Today's guest has over 30 years of experience and a track record of over 11% returns for the last 14 years. G'day, Darren.
G'day, Phil. Great to be here.
Thanks very much for coming on. Darren Thompson is Chief Investment Officer at Equity Trustees. He blends strategy, finance and performance-driven investing to deliver returns for clients. Equity Trustees was founded nearly 140 years ago by Sir John Madden. It's a cornerstone of trust management in Australia, safeguarding billions for charities, super funds and investors. So Darren, you've had a long career. Tell us about your career before joining Equity Trustees. How did the young Darren leave university and join the workforce?
This is probably the last place I thought I'd end up, to be perfectly honest. I was born into humble beginnings, son of teenage parents in Lithgow, so investing was not a part of my upbringing when I was growing up. But when I left university, I went into the chartered accounting world and had the joy of becoming a tax specialist with one of the big firms. And that gave me a really good grounding in financial analysis and also problem solving. But when I returned from a stint overseas, I came back and I wanted to do something actually interesting with my life. So through an ex-colleague, I had an opportunity to go to a small stockbroking firm and I became an analyst in stockbroking. And that was my first entree into the investment market. So I started with a blank spreadsheet covering tourism and leisure stocks and building financial models, covering companies like Sydney Aquarium and tourism and leisure stocks, hotel stocks. And so through that, I worked in stockbroking for a period of time. But I soon discovered that really my desire was to be on the other side of the fence, what we call the buy side, where you're actually investing clients' money rather than advising on how it to be managed. And so I had an opportunity to join IAG, the old NRMA at the time, and grew through that process to rise through analyst to portfolio manager. We had the opportunity to start a small boutique investment firm back in 2007, ran that successfully for a period of time. And then the opportunity arose to join Equity Trustees in 2018, and I've been here ever since. I'm very happy to be here.
So do you find an accounting background gives you a good foundation for analysing a company?
Absolutely. I think at the end of the day, we're looking to distill knowledge and assessments and opinions, but back into the financials to determine a valuation and looking to assess the value of that the asset's currently trading on with our assessed value. So definitely think there's a lot of different backgrounds in investment markets, but I certainly think that financial analysis and accounting is certainly a sound background for that.
Yes, because it's really about the numbers, isn't it, for companies, what they call qualitative research as well, where you're sort of looking at where you think a broad trend might be emerging. But do you really believe it's in the numbers?
Oh, absolutely. I think it ultimately comes down to the numbers because at the end of the day, everything has a value. And so trying to understand and get to that sort of intrinsic value is a key element in having confidence in investing and assessing where an investment is currently trading at versus your assessment of value and giving you conviction, therefore, to make that investment decision. So I think whilst there are various components and skills that come into making a decision, having a handle on the numbers is key.
I think it's important, and especially for beginners who are listening to episodes like this, to understand that the value of a company, and hopefully reflected in its share price, really is driven by the underlying profit, Isn't it? Is there any particular metric that you use and that you like to look at to determine what that's going to be, or is it a combination of factors?
It's definitely a combination of factors because it's a combination of the amount of earnings, if you like, or the amount of cash flow that a company might generate, but I guess the quality and the certainty around that. So some companies might have strong potential but be highly risked as to how they might achieve that, whereas other companies have probably less upside but probably less downside. So trying to bring those factors together, I think, is important. So like there's value in steady earning streams that grow over time, and there's also value in potentially growth in earning streams, albeit that they might come with higher risk. So balancing up that risk and reward is really key. And try and understand the investor's appetite for that, because it's one thing to say that you're happy to undertake or take on risk, but like periods that we're feeling at the moment when there's volatility, some certain investors aren't necessarily that comfortable with taking on the extra volatility.
So what do you advise them when they sort of get on the phone to you and say, I can't stand this anymore?
To be honest, generally sound advice is if you've got a sort of a well-formed long-term strategy, the best thing to do is offer nothing, particularly when times are volatile, because what we really try and entrench is that the underlying volatility in earnings and dividends is generally much lower than the volatility in share prices. It's a little bit like the old cliches that if you had to stand on the corner and sell your house every day, the price you got from that would vary wildly, but over the longer period of time, it will generally grow in value. And that's true of most investments, and particularly investments where your cash flows are growing. So the best advice we generally give investors is you're soundly positioned. We're in a good portfolio of businesses. Don't get too excited when the market goes up too aggressively, and don't get too disappointed or nervous when the market goes down, because there's an old adage in the market that in the short term, the market's a voting machine, i.e. it's more driven by sentiment, but in the long term, it's a weighing machine. It has greater regard for where earnings end up over time, and values will gravitate towards that over the longer term.
Yeah, it's hard being a long-term investor who looks at a 5-minute chart.
Very true.
Constantly.
Absolutely.
So when you first joined Equity Trustees, did you get an induction course? Did they tell you about the history of the company and what it means for the business and so forth? Because it's a long history. Run us through it.
It is a long history. It's great. It makes me feel young. So Equity Trustees, we do get an induction course, and I think it is important to some degree because the cultural dynamics of that do sort of run through the business. Equity Trustees started in 1888. It's a very old school Victorian firm. I think it's evolved a bit since then, but really fundamental to its existence is looking after the assets of its clients and particularly those who are often vulnerable. I think it originally started as looking after the assets of widows and orphans, because back then they often weren't seen to have the investment acumen, if you like, to look after their assets. So it was to safeguard assets of those who were perhaps needed that help. And whilst definitely the world's evolved since then, that underlying principle of looking after the assets of others is a real core value of the business. And one of the key values of the business is around trust. And when the core to your business is, the core of our clients' funds are assets like perpetual charitable trusts and endowments, which have essentially almost an endless lifespan. When you have clients like that, you need to be able to demonstrate that you'll be trusted to do what you're going to say you do over and over again. And that's kind of instilled through everyone in the business and sort of helps drive a lot of the culture.
Can you explore a little bit more of that? Because, I mean, it sounds like you said, it's establishment Melbourne, and people outside of Melbourne don't really understand how deeply that runs through the system. And I'm assuming John Madden, he was a Chief Justice, wasn't he? He was one of an early Chief Justice of...
He was. He was apparently one of the first four, I learnt this in my induction, he was one of the first four graduates from law school in Melbourne, and he was a Chief Justice. And I think, through its history, Equity Trustees has had a lot of high-profile directors and managing directors. Robert Menzies was one of the directors of the board. Jeff Kennett was the chair when I first joined in 2018, and I think his grandfather was also a chair of Equity Trustees. So it definitely has that Melbourne heritage, although it's now very much an Australian-wide business and is a very contemporary business these days, albeit with that heritage.
By the way, I was only joking when I asked the question about the induction. I didn't realise there actually was an induction. That's good to hear.
Yeah.
So how has the company changed to adapt to the times?
Look, to be honest, I think what we do is relevant now as it was back in 1888, and that is looking after investors' assets and looking to grow those assets. Whilst every investor has slightly different, investment objectives and risk and return tolerances, generally, it centres around a core proposition of growing the real value of capital over time, whilst also have a secondary purpose of generating an income stream, for whether it be for charitable bequests or granting, or whether it be for operational purposes or living expenses. So it's really growing capital over time and generating income. And I think that's as relevant today as it was back in 1888, to be honest. So whilst the investment strategies and the types of investments, whether it be private market assets or investment classes, may have evolved, the core principles are very much the same.
So you've got a pretty impressive record, that 11% per annum. Is that after fees?
It is after fees, yes it is.
Yeah, that's pretty good. How do you approach it? I mean, there's not a lot of people who can nail those kind of returns.
Look, there's probably a few guiding principles that I sort of have adopted and helped to apply here, and obviously that track record extends before joining Equity Trustees. But essentially, I think, I didn't take too many things away from my economics degree, but probably three core principles I took away with me is there's no such thing as a free lunch, meaning that if you want additional return, you've generally got to take on risk. The second one is the power of compound interest, and that is that essentially if you're starting and just continuing to grow consistently has the power to grow asset and wealth over time. And the third element is that whilst the markets are efficient, they're not always rational. So it provides you with opportunities to ideally obtain, if you've done the work and you've got a disciplined process, you can identify opportunities to acquire assets at the right price and ideally sell them if they become overvalued. So trying to bring those three elements together is, I think, probably core to investment philosophy, if you like. And I guess it really comes down to having a good team. Certainly I haven't generated those returns individually. It's by having really good people with great knowledge, applying a consistent investment process.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
I think you said two words in there, disciplined process. Let's focus in on that a little bit. What is that disciplined process?
Yeah, well, the key asset class that I've been involved with over my career has been Australian equities, and certainly that is the core foundational pillar of many of our strategies at Equity Trustees. So really, in terms of who's driving that here at Equity Trustees, that's one of my peers who I joined Equity Trustees with, Chris Haynes, and his team are really implementing that investment process. And our name for that is quality at a reasonable price. What that means is we are looking for attributes of investments, companies that have ideally good management, sound balance sheets, good cash flow generation, ideally good market leadership positions and growth prospects. They're either in a growing market or they're certainly growing within that market segment. They've got good governance in place. They've got a good social license, a whole range of criteria that we would say makes a quality company. Now, the reasonable price piece is that generally those companies aren't trading particularly cheap because they've got those desirable attributes. But from time to time, they can fall out of favour. So we're looking to acquire those and hold them through time. So the discipline is around having a team, and we think we've got a really strong team of analysts who know their companies and sectors well. So they'll stay abreast of those drivers, identify the best companies to be invested in, and either we're already holding them or we get an opportunity to acquire them at the right price when that becomes available. So, and then the second element is if they become mispriced or if we get the thesis wrong and our assessment is wrong, which does happen, it happens plenty of times, that we've got the discipline to say, okay, circumstances have changed, we're going to exit that investment. Or if it becomes too expensive, that it's, well, there's better value elsewhere. So it's having that sound investment process around what constitutes a good investment and then being able to have the right behaviour elements to manage that portfolio of investments at any one point in time.
So when you're cutting and run on a particular stock or investment,
Yep.
Is it usually around earnings season or confession season, something like that? Is it based on the numbers, or can there be other factors that weigh on your decision?
No, it could definitely be both. Confession season or earnings season is definitely often a time at which information becomes more visible. Certainly over the 30 years that have been in markets, disappointingly, that's become more the norm now. Back 25 or 30 years ago, you could probably get a little bit more information through being out and meeting with management and doing your own research. But certainly it's become a bit more vanilla now. So really these days, a lot of your assessment needs to be based on really bringing together public information and forming a balanced assessment. So often that is more visible at reporting season. But certainly we have a very strong company visitation program where analysts are having over 1,000 meetings a year with company management and or competitors in order to try and get that understanding of how businesses are operating.
Have you got a specific example of a process that's happened recently like that?
Yeah, no, look, it's probably one good and one bad. Yeah, so the positive one would be an investment which we've held for a period of time in ResMed. Yeah, so ResMed is a maker of CPAP devices to treat sleep apnea in the main. It's got other uses, but that's kind of its core business. About 12 to 18 months ago, there was you might be aware of GLP-1 drugs that are essentially looking to reduce obesity and so forth. There are diabetes drugs that have now been used for reducing weight, and overweight people have more sleep apnea, and so there it was seen as being a potential adverse outcome on ResMed's long-term growth. So we spent a lot of time, and our analyst, Paul Darren, he spent a lot of time assessing GLP-1 drugs, speaking to medical distributors in the States, doctors, sleep centres, a whole range of activities, the company, competitors. And through our assessment, we believe that the risks are somewhat overplayed, but the stock was sold off quite aggressively based on that risk. So we essentially added to our portfolio holdings, and that's proved to be a good decision. Notwithstanding, it's now going through some issues relating to Trump tariffs and how that might impact, but the world's always eventful. A secondary example would be we've got a holding in a company called James Hardie, which again has been a long-standing investment, a really strong core proposition, growing strongly in the States in building materials, but certainly fibre cement. And over a long period of time, the management team there had rebuilt that company after its issues with asbestos going back 20 or 25 years and had a really strong track record of delivery. But there'd been turnover in senior management and the board, and they've just made what we consider to be a very poor investment decision they've got a takeover offer in place to acquire a company in the US called AZEK, what we see as being an expensive price. Yeah, we don't need them to make that portfolio decision on our behalf, but they've nonetheless done that. And disappointingly, they haven't gone to shareholders for approval for that. So that was an example where we've now been talking to the board and also management around that. And we need to assess the outworkings of that decision and what it means for our investment in that company. So they're two different examples, I guess, of where new information has come to light. One good, one, or even where there's been perhaps potentially negative in the ResMed situation, where it provides a potential opportunity.
Yeah, there's been a long tradition of Australian companies making overseas acquisitions which haven't worked out very well.
Generally, I think Australian companies overestimate their ability to translate domestic success into international success, as a rule.
Mind you, Nick Scali's been pretty good at it.
Oh, no, there's certainly exceptions, and there's businesses like Macquarie and others that have definitely grown successfully overseas. It's just that there are a number that haven't.
So are you designing portfolios for different clients and reweighting depending on their particular needs, whether they're a charitable trust or retail investors, for example?
Yeah, so look, I think one of the key things we attempt to do is to understand, we touched on it earlier, but understand really the key drivers of the client. What are the investment objectives, and maybe sounds like a ill term, but really just what are their risk and return attributes? Do they have a need for the capital they're investing? What are their income requirements? What are any other characteristics, whether they want a responsible investing overlay and things like that. So getting that understanding right up front helps us structure, the portfolio construction and weightings by asset class and the type of investments. And so that does vary by client. I mentioned earlier, a lot of our clients have a long-term time horizon, charitable trusts, endowments. So that enables us to invest for the long term, which means that we can have a higher weighting to growth assets, which are proven to deliver better average returns over the long term, but they experience greater volatility through that. So that their growth assets and higher weighting to growth assets are very good for clients with long-term time horizons. But if, for example, you need to withdraw capital, you don't want to have to withdraw capital at the wrong time and endure what we call sequencing risk, the risk that you have to take your money out at a low point in that cycle. So they're the sort of things we take into account. The tax status of clients, for example, one of the reasons why Australian equities have proven such a sound placement for a lot of our clients is because of that high after-tax income stream that had been provided by franked dividends. And so any change to tax status or those sort of issues are definitely taken into account.
You mentioned about some clients wanting the overlay of, I can't remember the term, but like for social good, making sure that the companies that are being invested in. How do you adjust for those kind of requirements?
Yeah, so we call it responsible investing. That's the term we use here, whether you call it ESG, environment, social or governance. So we look to do it in two ways. One is that we look to integrate responsible investing as a component of our investment process. And that's not just because it kind of makes us feel good or we think it's the right. We just think ultimately there is a natural alignment with companies that perform well over time, that also there's a good correlation between how they perform over time and the way they attend to those issues. There's a term that's used to be used quite a lot, social license to operate. And that's particularly true in this day and age where companies are, I think, not only seem to be making profits, but also do the right things by their customers and other stakeholders, employees and others, generally will have greater acceptance. So we think there's a good correlation between good investments and responsible investing. A number of our clients also want to exclude certain sectors that they view on ethical grounds that they would like to exclude. So alcohol, gaming, those where they consider that to be not providing a social good or doing social harm. So we also run specific portfolios that exclude those industries and enable clients to invest without having exposure to those type of investments.
What are some of those kind of investments we're referring to?
So in
tobacco and weapons, obviously they're the main ones, but are there other ones?
Yeah, so an example of that would be like Aristocrat or Light & Wonder, make money from gaming machines. That's certainly the key one. Treasury Wine Estates in the alcohol space. So it's really around alcohol and gaming in Australia. In international portfolios, it also extends to tobacco and weapons as well.
So what advice would you give everyday Australians looking to grow their wealth without getting lost in the noise of financial jargon and hype?
Yeah, look, to be honest, I think it touches on a few things we've talked about, which is generally just getting started is a key thing. And ideally investing an amount that you don't feel you need to touch. So particularly if you're going to be investing in the stock market, don't invest in the market with a view that you're going to make rapid gains. And I've made this mistake in my personal portfolio. I tend, my client portfolios have outperformed my personal portfolio because there's a tendency to look for quick wins. And generally, the better investments are those that just grow steadily over time and compound over time. So I think the best advice I would say is not try and go for the quick win, not look to make 10% next week, but look to invest in a portfolio of companies that are going to grow over time, because that's where that compounding really comes to play. And essentially, the behaviour element is so key, not getting caught up in, don't look at it every day, because the tendency will be to sell when things look bad and buy when things look good. And that's generally just the wrong time to be doing either of those things. So I think it's get started. Don't try and hit it for the fence, ones and twos rather than hitting sixes, and just start. As Peter Lynch would say, a really famous investor, it's time in market, not timing the market, which is key. And I think that's really, really important.
It's interesting that you say that people are looking for quick returns, because that is a psychological mindset that people have who don't have no experience in the market.
Correct.
Just tell us about, because you mentioned earlier about compounding. Tell us about the beauty of compounding.
Oh, absolutely. I do think there is... and we all suffer from it. When I first got into the markets, my family would call up and say, "I've got this great scheme. It's offering me 15% return, and it looks great." And my immediate thing is, without even knowing what it is, just don't do it, because again, there is no free lunch. And so, I think that one of the reasons I'm really attracted to markets is it just kind of makes sense, because company earnings, economies grow over time. If you're invested in good, sound companies, they will grow with the economy over time and really add a little bit on top of it. So if you're growing your investments at, call it nominal economic growth, adding a little bit more for the fact that you're in good companies, and that compounds over time, that is really, really valuable. So whilst it was at my economic degree, we talked about compound interest, there was a really old gentleman, Don Stammer, who's a really well-known economist who I work with at Deutsche Bank. And he would start every meeting. He was very well respected. He would start every meeting with the power of compound interest. And no matter how sophisticated an investor you are, that principle is just so powerful. But in order for that to have effect, you've got to actually start, and you've got to leave the assets there and not try and time the market. So, it's like the old clip. If you continue to grow assets, by the time you're building off the power of the 10th year and the 11th year, it's really powerful. I think there's a stat that 98% of Warren Buffett's wealth accumulate after the age of 58. That's because he continues to compound on a very large number and has maintained that discipline over a long period of time. Now, we expect to be Warren Buffett, but I think that can be also quite powerful just for everyday Australians.
So do you have any warnings for everyday Australians? Because a lot of people fancy themselves very quickly as stock pickers, as opposed to possibly going into a fund of some sort where someone else is looking after it for you. What would you suggest to people who get that bug before they do anything stupid?
Yeah, look, I think it's inherently a good thing to want to invest, but I generally think that the emotional piece is underestimated. We talked right at the start about what you need to have an investment, discipline, and that is sort of knowledge and applied knowledge and assess outcomes. But as much as anything, I do think the emotional piece is really important. I think in investing is a combination of being confident without being arrogant, having enough knowledge to have conviction without anchoring and not being able to change. So my advice to everyday Australians is, which I am one, is to...
You're from Lithgow.
I'm from Lithgow. I'm a coal miner's son from Lithgow. Is to not get too greedy and essentially just to be dispassionate around it. If you've made a sound long-term plan, stick to it. And generally, I can't tell you what the market's going to do tomorrow. I can say with a bit of greater certainty what's happening in a year. I have a far greater certainty the longer the time frame. In 7 or 10 years, I think the market will be up and will be up soundly. But what happens tomorrow is really a lottery, particularly in this day and age, depending on what side of bed Donald gets out of. So I think it's around having a long-term plan and just having the behaviour element to be able to stick to that.
So do you have a view on any opportunities and risks in Australian equities right now?
Yeah, look, for all the things I've said, I actually think there's probably a little bit of downside risk to markets at the moment. I think over a period of time, there's been a bit of complacency built into the market pricing, whether we view it on price to earnings multiple, a lot of technical jargon, but price to earnings multiples or price to book, equity risk premium. There's a whole lot of jargon, but if you look over long-term trends, it's trading a little bit expensive. Now, that sounds like, well, you shouldn't invest, but I think if you're investing for the long term, you can still invest now soundly, but that doesn't mean that there isn't some near-term downside risk. So in the short term, I think we think there's greater opportunities in some of the more defensive sectors. We think some the healthcare sector, for example, there's certainly some stocks in that area that we think that offer really sound value. Stocks like CSL, which have really strong long-term pipeline, again, being buffeted around a bit by tariff noise. Stocks like ResMed I've already mentioned. A stock like Telix, which is around treatment of cancer and having radioactive isotopes to identify cancer. We think that's got good growth prospects. I think there's just good opportunities in some of the more defensive names like Telstra and Telco. So it's good, sound, defensive earnings stream. The data centres are an area which have come right back. So we definitely think that AI and the consumption of data is a long-term thematic. Again, got a little bit exuberant, but then has pulled back quite quickly with the DeepSeek type discussions and potentially a pullback of data center demand. So companies like NextDC and Goodman's are at an interesting place at the moment as well, given, again, they're fallen out of favour with the market.
Goodman's, are they involved in data centres as well?
So Goodman Group.
I didn't realise that.
Yeah, Goodman Group. They've obviously been a massive success story, predominantly through industrial property, but they've certainly one of their stronger growth streams is through data centres, both here and into Asia.
What about Macquarie in that space? Not the bank, the telco.
No. Oh, Macquarie Telco. Yeah. Interesting. I'm probably not one that I'm as familiar with in terms of their exposure there. Certainly, Macquarie Bank has done well more recently through their sale of their part ownership in AirTrunk more recently. And again, Macquarie Bank, I think, is, again, it's a very well, we talk about quality elements. It's a very well managed business with good structures, diversified revenue streams that has had a meaningful pullback in the current market conditions that still think has good long-term potential.
And that's the thing with good companies, isn't it? It's very hard to get the timing right to get into them. I mean, there's so many great companies on the ASX, but then you look at, their earnings or the PE, and they're always quite expensive.
Well, generally,
it is. Generally, that's the case, isn't it?
Yeah, you generally need to. So that's why we talk about having a quality at a reasonable price, not at a cheap price, because very rarely do things get cheap. But as long as they're reasonable, and we touched on before about what should mum and dad investors think about. I do think either a good quality manager with a portfolio of stocks, or an index fund, or a cheap, or if you're not looking to identify a manager, a value index fund is also a good way to play it. But I think it's around having a good portfolio of companies rather than necessarily putting all their eggs in one basket, because it's not around trying to hit it out of the park by getting one right and really blowing that out, because even good managers make lots and lots of mistakes in terms of the assets we invest in. So it's having a portfolio that you average out. You get more right than you get wrong. And ideally, your winners have more of an impact than the ones that don't work. So it's around having a portfolio of companies, I think, is really important.
You mentioned a little while ago about managers and management and how they treat staff as being a key, or one of the key factors that you look at. What are the kind of tools? Because these days there's plenty of opportunities now for employees to even, rate their own companies that they work for. Do you use tools like that, or any other thing?
We have those regards. To be honest, it's generally probably more of a negative screen, where if there are red flags, we certainly have our own research, and we also use providers like MSCI and so forth and also proxy voting firms to provide us with screens around that sort of data. So it's certainly an indicator. And companies do have a cliche about people being their greatest asset. Not all sort of adhere to that, but I think it's really where there are adverse cultures where we would see red flags. And there's probably some examples of that in the marketplace at the moment, which caused us to act. So I don't necessarily want to call them out here, but there's some that are quite visible where it certainly would materially impact our view around the value of the company's opportunity set. I'll mention, so WiseTech, for example, a really sound underlying product, but with significant risk around and issues around, I would say, corporate governance and I would argue the culture within that business. So that to us is a real red flag and makes it difficult to invest in.
Yeah, it's always difficult to balance that. I mean, we've discussed WiseTech so much on the podcast, and the Australian Shareholders Association, who I'm closely involved with, they're very much looking for good behaviour amongst management teams. But then there's other investors who say, look at the value that he's created, without naming names.
No, and I understand that. So there's a balance between, there is well, I don't know how fine the line is in this one, but there's founders who drive and are dominating cultures often drive significant wealth, and there's a lot of founder-led businesses that have done extremely well. And certainly, I'd argue WiseTech is very dependent. But again, that is the flip side. That is a risk. If you're that highly dependent on a single individual, if that individual's no longer there, then that's obviously a concern. And I guess it's looking to balance and having the right sort of checks and balances around that.
Well, let's end on a positive note.
Yeah.
Name some management teams that you're very impressed by. Just one or two.
Look, that's a really good question. Look, it's probably recency bias because we just talked about it, but Macquarie has been a company that even from my analyst days have been closely associated with. That was back in the days of Alan Moss and then Nicholas Moore and then Shamara. It's one where, to some extent, it was probably seen as having sharp elbows and a little bit aggressive, but they've always had a high degree of meritocracy and governance and well regarded, and that meritocracy has enabled it to grow and develop in areas, and I think reward those who contribute to the business. So I think that management team has, one of the reasons why I would call it out is it's continued to innovate and continue to find new areas to grow into in a pretty challenging industry. So we'd certainly would rate that management team. I think other businesses, the management teams have continued to evolve. So at some points in their cycles, they've been good, and others they perhaps not so. Certainly over time, we'd say that the CSL management team have continued to be generally sound. Again, it's had degrees of evolution and corporate involvement, but that would certainly be a couple of examples where we think that the management team is really sound. In the resource space, there's probably been a positive evolution of capital discipline in recent periods compared to decades past. So overall, I'd say the management teams in our key resource names have shown generally sound discipline within that industry. So
are you referring to some unfortunate overseas expansions with certain companies?
Correct.
Where, capital management's really important, isn't it?
It's
where that money is going to be put, because there's very few places that you can place that capital, isn't there?
Absolutely. We talked about James Hardie. It's really decimated a long period of, trust, and has sort of decimated that in one decision. Resource companies are renowned from spending their good fortune in ill-timed decisions, generally at the top of the market. Shale assets in the US, or a whole range of examples we could point to. So, capital discipline is really key. And if you don't have a good use for the capital, don't spend it. Give it back to shareholders and allow that to be deployed at an appropriate return on equity. That's what we want.
Okay, Darren. So tell listeners how they can find out more. And I'm disappointed because I don't think you've got any socials. I'm not sure if that's a good thing or a bad thing.
I probably should do a bit more of that, but maybe this is the start.
But generally it's the website and LinkedIn, isn't it?
Yeah, maybe this is the start. So look, where you can find more about Equity Trustees is obviously on our website, equitytrustees.com, LinkedIn. But look, we really welcome any incoming. I think if you're interested in investing, please give us a call, and we'd be glad to have a chat to you.
Yeah, at least have a look at the history lesson on the website as well in the about.
Exactly.
Darren, thank you very much for joining me today.
Thanks, Phil. Absolute pleasure.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.